I think this got to be lecture number 5. Everyone pay attention. We are switching. This is our permanent textbook. It finally arrived in the bookstore. You should actually go ahead and buy the textbook, okay? And you should start coming to class prepared. This means the following. Next time you got a quiz, right?
Yes.
You have a quiz. So you should also prepare, at least for next week, you should prepare end of chapter problems. And we begin with exercises. And I have marked them for you. I'll send them to you in the system. It's QS 2-1. It's a quick study. QS 2-1, 2-2, 2-3. Quick means it takes less than a minute. Very quick, very easy. 2-4, 2-5, 2-6. Skip 2-7, and then we go 2-8. And then you do exercise. Exercise 1, 2, 3, 4, 5. Basically do all exercise. 6, 7, 8. That's good enough, I think. I'm going to see some more, up to 8. Because you will need to prepare for class. Otherwise, most of you are, it doesn't anything to do with you. It's for any student in accounting. If you don't solve the problems, most students in accounting are likely to fail. That's the reality of accounting. Today we begin chapter 2, and chapter 2 is very important. It is fundamental to accounting to understand. It's about analyzing and recording transactions. And it builds on chapter 1. Let's see what we got in here. So, what we have here, everyone, class again. Alright. What we always begin in accounting is called a source document. A source document is a document which is coming out of somewhere. It may be coming out of your customers. It may be coming out of your suppliers. It may be a receipt that you issue to your customer. It may be a salary. It's called a slip, which when you pay to your employees, right, to your workers. So you always begin with some source document. When you get a source document, you record from the source document in a journal. I'll be explaining today what's a source document, then I'll be explaining separately a journal. Then, from a journal, you're going to post it in a ledger. And we call these ledger accounts. And then the last step is prepare the trial balance. So today, possibly next time, we're going to complete, and these are steps. This is called the accounting process. And a process means a sequence of steps. Step 1, step 2, step 3, step 4, okay? So you got an accounting process, you got various steps. You need to understand each step. Now, you should be intelligent enough to know what's quiz number 2 on chapter number 2. It's, you will be given transactions and you'll be required to post them in a journal. Record them in a journal, then post them in the ledger, and to prepare a trial balance. And then the last step is to prepare the financial statements. Most likely this will be also your midterm too. Alright, so source documents. Let me try to get the exact definition of a source document. Is a document, it's just a piece of paper, okay, which identifies and describes transactions. So it identifies, tells you, and describes a particular transaction and events which is recorded in the accounting system, which must be recorded in the system. So it describes what happened. Examples will be, I gave you check, when you write the employees a paycheck. Or when you write to a customer a check. For example, in the United States, you pay your water, you write a check. Okay? You pay your electricity, you write a check. So whenever you write a check, you have a copy of the check. And the copy of the check is a document, okay, which you use. Example will be employee earnings records. Every employee has got an earning record, okay? And in that earning record, you will have specific information about the salary and all the other information. Because employee will also have taxes. You got to record the taxes. Social insurance, you got to do that. We are not going to do this in chapter 2. In just chapter 2, it's just wages and salaries, okay? And it's an expense. So you have to remember what is an asset and what is an expense, okay? Next, bills from suppliers. I gave you an example. They send you a little bill and say, your water is due that much money. Or they send you a bill. A bill is simply a document asking you to pay. For example, electricity. So we call this electric bill. The other one is called a water bill. You can also have cable. Cable bill means the bill for cable TV. You can also get, it's called internet bill. Internet is for your internet. In us, where we have a regular plan, you get a mobile phone bill or just a phone bill, okay? It could be a stationary phone, it could be mobile. They just send you, have to pay $30 this month. So, whoever wants money from you is a form of a business, they will send you a bill. Please pay that amount. Okay? Usually for, we call these utilities and services. Oh yeah, you students. Sometimes the university will send you a little letter telling you that you need to pay tuition and fee, right? By a certain date. So they'll send you a tuition bill. They may send you separately a dorm bill if you live in the dorm, right? And every month they say, please pay whichever, either go to the bank or go to the cash register, wherever you're supposed to pay. Pay here or pay, there. They're going to tell you how to pay. So this is all bills. Purchase orders could be both ways. You could have purchase order from your customers asking you to purchase shirts or pants or belts or shoes, okay? Or you send a purchase order to buy something from your supplier. Well, what will happen is when you send them a purchase order, they will later send you a bill. Oh yeah? Fun time? So you send them a purchase order. When they ship you the goods, usually with the goods, they will send you a bill. Bill to pay whatever. Let's say you order 50 shirts, okay? Or you order, let's say, 100 kilograms of fish. You're running a restaurant and you need fish. Say order. So when they send you the fish, they will send you inside a little order. Or sometimes they're going to call, when it's purchased, they're going to call it invoice. Invoice is when you purchase something. Source document will be bank statements. The bank will send you a statement of what you did and everything, and it represents a source document. Yeah, sometimes sales tickets. You go to the movie theater, there's a sales ticket. I was going to Fantasy over the weekend, right? And they want a sales ticket, $1,500, right? Right? So, see how cheap the textbook is only $500, no big deal, right? Right? You can go to Fantasy or you can buy 3 textbooks. the comparison of value, all right? Right? This is, you compare the purchasing power. So, you get a sales ticket. So, sometimes there's a sales ticket for a movie theater, for a car show. They may be a big car show, so if you want to get inside, they sell you a ticket. Well, the ticket is also, well, when I am traveling, let's say to another university, they want me the airplane tickets. The airplane ticket, at least that little piece in there, it is a proof that I fly. So that my name is in it and that I actually fly, okay? And they'll use this as a source document in their accounting system for expense. They will reimburse me the ticket. To reimburse means to give the money back. To give the money back. So, when I fly, let's say from Bulgaria to here, I pay the ticket out of my own pocket. When I present the invoice and the ticket itself, they reimburse the money. They pay the money back to me. So reimbursement is paying back the money which somebody paid before. You just recover and give the money back. Okay? Example of a reimbursement for you will be, you live in the dorm, okay? And you plan to stay there for 10 months, okay? And you pay the dorm for 10 months, but you live only 9 months. When you live only 9 months, and you don't live the last month, you notify the university. The university will reimburse you for the 1 month overpay. You pay 1 month more, they return back the money, okay? So all these represent source documents. All right, the next key step is account. That's where the word and the subject accounting comes. Accounting comes from account. An account is simply a record, usually a piece of paper. Today it's going to be an electronic record, a file. So it is a record which increases or decreases for a particular asset, liability, equity, revenue, or expense. So a simple question is, which are the 5 types of accounts? And these are asset accounts, liability accounts, equity accounts, expense, and revenue. So these are the 5 types of accounts. And here's the next page. It's a record. So it will be just a piece of paper. And I will be showing you soon and explaining that the most common, the most popular is called the P account, which is coming very soon, in a few minutes. So that's what account is. And from account, you get the general ledger. And a general ledger is simply all accounts together. It's a book of account. So it's a record containing all accounts. So if one account literally is one sheet, okay, and the second account is second sheet, the ledger is going to be all accounts. If you have 20 accounts, it's going to be 20 sheets, okay? It's just one book. That's all there is to it. So the ledger is simply all accounts. And for each one, you're going to have the detail of every increase and every decrease. You're going to see it again in a minute. And that's what you're going to be doing for your homework assignment and for exercises. That's what we're going to be doing. We're going to do accounts and so on as we continue. So, accounts are, and we just explained, asset accounts, liability accounts, and equity accounts. We already studied and already covered, it's very important, the equity components. Remember from the previous chapter what affects equity? Affects by investments, it's affected by withdrawals, it's affected by revenues, and it's affected by expenses. Now, the equity account is simply called owner capital. Owner as in John, or as in this case, for the university is going to be PSU capital, okay? PSU, the name of the business or the name of the person who owns the business, and you say capital. So that's the equity, and that's why we say accounts. There are many equity accounts, okay? I'm going to go through these, okay? Let's see what we got. Oh, they got these very, very, very nice effects, right? Cool stuff. So, let's discuss. You need to understand and remember, these are the most common asset accounts. So, you need to understand and remember, again, the 5 types: asset account, liability account, equity accounts, revenue accounts, and expense accounts. So, remember these 7 or 8. Simplest one is cash. And cash comes in 2 forms. So, cash is money which is available for immediate payment. And comes in 2 forms. Cash in the drawer, meaning in your wallet. It's in the cash register. That's how we call it, cash register. Or cash in the bank. Cash in the bank is in the form of a bank deposit. So, a bank deposit usually counts as cash. Usually. Okay? So, you got 2 types of cash. Cash is in banknotes, and cash is a bank deposit. Okay? The key is, can you use it for immediate payment today? If it's in the bank, can you make a bank transfer? Or can you write the check against it? Okay? And if it's in the vault, can you actually take it and make a payment for whatever reason? So, that's simply cash. Let's see if we have anything, nothing special. Next one is accounts receivable. Now, I will be also giving you, for your reference, to begin reading. In a university, it's very important that you get the habit of reading the book. So, right now, cash here is on page 53. It tells you what's account and assets. Cash is on 53 in the middle, okay? So, we continue with 53, accounts receivable. This is money that you will be collecting because you made a sale to a customer on credit, okay? We also say on account, okay? That's why it comes account receivable. I already explained this last time. Let me repeat. Account is usually a customer. When you sell on account, means you sell on credit. He takes the good today and he pays next week or next month, whatever the arrangement is, okay? And receivable means you will be receiving money, meaning payment, meaning cash, from the customer, okay? So, accounts receivable is what your customers owe you and you will be collecting from them. That's account receivable. Note receivable is very, very similar, but instead of an account, you actually have a note. And a note is simply a written document with a promise to pay. To pay a particular person a particular amount of money on a particular date. So, a note will be written, it will have a signature. For a big amount, it will also have a notary, but it will have these 3 components. I will pay you 10,000 baht by July 31st. And when you say you means nothing. It's got to say, I pay John Smith, okay? And John Smith can take that note and can do other things that's long. We're not going to worry about it in the account. But a note receivable is simply a written promise to pay a particular amount of money on a particular date. That's the key, okay? It is also known as promissory note. So, note receivable is known in law and accounting as promissory note, okay? If they don't pay, they can get in big trouble. I mean, you can sue them, they gotta pay you that money, they gotta pay you the legal cost, they gotta pay interest and all sorts of other things. So, note receivable is a promissory note is a very serious document about owing money, and you can get in big trouble, legal trouble, if you don't pay, if you have to pay. Next one is prepaid account. This is tricky, but it's actually easy to understand. A prepaid account is the same as a prepaid expense. It is an expense that you will make, but not now. The one example that I give you is the school year begins and you pay your dorm rent for 10 months. When you pay for 10 months, let's say 5,000, you pay 50,000 upfront, okay? So when you pay the expense upfront, it is not an expense, It is an asset. When the first month begins, you take the first month rent becomes an expense. You still got 9 months of asset. When the second month comes, you take the second month rent as an expense. And you still have 8 months of, it's called prepaid rent. So prepaid rent. Exactly the same works with insurance. You pay your car insurance or motorcycle insurance or house insurance or health insurance for 1 full year. At the end of the month, you have only one portion, 1/12 of that insurance is expense. The other one is still an asset. For a business, how does it work? I'll give you an example is with the university. University pays for us professors, it pays insurance. And they can pay annual insurance. When they pay annual insurance, 12 months ahead, I'm just picking a number, that's not a true number. They pay 1,000 a month, and they pay for 12 months. 12,000 is not an expense. It is a prepaid amount, a prepaid health insurance. When the first month comes, they take 1,000 expense as part of salary. Next month, 1,000 expense. Next month, 1,000 expense. So the prepaid account is 12,000, then becomes 11,000. After 1 month, 10,000, 9,000, 8,000. And as the year goes by, every month, expense increases and the prepaid amount goes down as you use the insurance. Or as you use the dorm. You live in the dorm 1 month. You actually live in there. It's an expense. You consume that, okay? So that's a very tricky one, and that will be a lot coming up in chapter 3 with adjustments and other things. Next one is your classmate was asking about supplies. And supplies is a little tricky. Now we're switching to page is 54. And supplies, here's how it's said, is an asset until you use it. Okay? The example which I gave are these little markers. The university can buy maybe 20,000 markers for a big university like this one. When they buy 20,000 markers to use for 10 months, okay, for 1 year, it's not an expense, okay? It is an asset. At the end of the first month, when we use part of them, that part becomes an expense and the supplies increase. So you got 50,000 at the beginning. Next month, you expense 5. 5 will be supplies used expense or supplies expense. it will be 45. After 1 month, it will be 40. So each month you write how many you use, and those that you use go as an expense. So you see the key word is use. When you use the rent, it becomes an expense. When you use the supply, it becomes an expense. Before you use it, it's an asset. Okay? So it's an asset, and as you use it, using it is the same as expensing it. Usage of something is expense in accounting. Then you have equipment. The difference between a supply and equipment is how many times you use it. We use this marker, when it's finished, you throw it. Okay? For the projector, you don't throw it. We use it tomorrow, use it next year, use it 2 years, 3 years, 5 years, maybe until it breaks down. So equipment is usually technological, which you use over and over and over again. Special word we have for, because we've had it for thousands of years, furniture. Furniture will be chairs, will be tables, sofa. Everybody knows what's a furniture. So it's a special type. We don't count it, we count it separately. Okay? So, equipment. Buildings is, usually we like to separate land from the buildings, okay? And buildings, here it is, land is a separate asset. So buildings is anything which you cannot detach or disassemble without destroying it, okay? So somehow, if you want to take it, if you want to put it apart, you will destroy it, okay? So that's what a building is. It's also a similar definition is of real estate. Real estate is land and buildings, okay? So real estate includes both land and building, okay? So when you have real estate, you must separate land from building. And the difference is depreciation. Depreciation is coming soon, means loss in value because of getting used or because of getting old. Okay? So a building, the value always goes down. Now, don't confuse, because that's the most common mistakes that all students and all people in the world make, thinking that the value of a house goes up. Not true. Most of the times, values of houses don't go up. And it's a simple mistake between value and price. The price may go up, but the value may go down. How is this possible? The answer is called inflation and depreciation of money. The price can go up, meaning the price in Thai baht, or in US dollars, because the Thai baht value goes down, okay? But when you measure the house in terms of bread, in your case in terms of rice, because you guys eat rice, so when you measure the house, how much it costs in terms of rice, okay, it actually falls down. When you measure it in terms of gasoline, because everybody's using gasoline here, right? So when you need, so that's why we say the value is always measured in real terms. And value typically goes down because you got rain, you got sun, the house gets old, okay? But the value goes down by 2% for the house, but the money, let's say Thai baht or US dollar loses 10% value, and the price goes up by 8%. And it creates the illusion, only the illusion, that the house goes up, all right? But usually, buildings, machines, and equipment, they depreciate. They lose value as they get old and used. Land has no depreciation. The value of land usually doesn't change much. All right, let's continue. Liability. Very cool, right? Very nice. Okay, liabilities are notes payable. Notes payable, as I explained, is exactly the same as promissory note. The difference is whether you write the promissory note that I will pay you. If I promise to pay you, it is a note payable to me and note receivable to you, okay? So, every promissory note is a note payable to the one side and note receivable to the other side. Same thing with account payable. Account payable, there is a sale on credit. For the one side is an account receivable, for the other side is account payable, okay? Those that will pay, for them it's payable. Those that will receive is receivable. What else we got? Unearned revenue. Okay. Unearned revenue is the corresponding for prepaid expense, and I'll explain a little bit more. Unearned revenue, the best simple example is you pay your rent for 10 months to the university. Now, for the university, it's a revenue, but they did not earn the revenue, okay? You pay them for 10 months, but you live only one. After 1 month, they will earn a second month of revenue. After 1 month, on the third month, they're going to earn the third month and the fourth month, okay? So, when you pay 10 months in advance to the university, for you, it's 10-month asset. For the university, it's 10-month liability. After 1 month, it's 1 month expense for you and 1 month revenue for the university. After 3 months, you get 3 months of expenses and the university gets 3 months of revenue. So, for every prepaid stuff, anything which you pay in advance, it becomes unearned revenue. And unearned revenue is earned in two ways. Either with time, because you use insurance for health or for car, or because you use rent. Or unearned revenue is when you pay money before you receive the good. Example, which is not in your case, but one example will be, the university says, look, we don't know if we're going to have 20, 30, or 40 students who want a textbook. They say, you pay the textbook 500 in advance, meaning you prepay the textbook, okay? And when we deliver the textbook, it becomes, then it becomes a real revenue. So, when you pay upfront, it's unearned revenue. It gets earned. Now, the key word earning means you deliver a good or service. So, for the rent, you take 1 month, and as they deliver 1 month, you see, you cannot think rent in terms of apartments. That's not correct. You have to think rent for February. That's the business. They're not just giving you an apartment. They're giving you an apartment for the month of February. That's one good. Then they're giving you an apartment for March. Apartment for April. Okay? Apartment for May. So if you are using now apartment for June, the rent that you pay for July, for you is prepaid expense, for them is unearned revenue. Now, here is a great example of unearned revenue is student tuition. When you pay tuition at the beginning of the semester, right? Do they want you to pay upfront? Is it a prepaid? or you pay at the end of the semester? All universities want tuition to be paid at the beginning. Okay? So, when you pay at the beginning, for you, it's a prepaid expense. For the university, it is called a prepaid tuition. So, unearned is the same as prepaid. They got the money, but they did not deliver education. When June, July, August, September finishes, and when the semester finishes, they will earn the revenue. They'll earn the revenue. Looking at you, okay? Okay. Okay. Next time you move, okay? So, you pay for 4 months in advance. That's what in advance means, prepaid. And every month they can say, oh, we earn 25% because it's 4 months. Each month, 1 quarter, 1 quarter, 1 quarter, 1 quarter. Okay? That's a very important concept. And then you have accrued liability. And accrued liability is a liability, something that you must pay, but you did not pay yet. For example, you have to pay insurance, and you're using insurance. Or you have to pay rent, but you did not pay the rent. So, you got a rent for June. If you pay in February or March, it's a prepaid rent. It's an asset. But if you got a rent in June and you don't pay by the end of the June, in July and August, it's already accrued liability. Means you were supposed to pay it, but you did not pay it. So when you have a payment, you can pay early, it's an asset, or you can pay late, it's a liability. When the payment is late, it becomes an accrued liability. Okay? So, if you pay early, asset. If you pay on time, expense. If you pay late or don't pay yet, it's a liability. Okay? So you have to be careful when we say, oh, we're paying rent. You always have to ask, when are we paying? For which rent? Okay? That's very important. And you got a bunch of equity accounts. We studied them. I repeated in this course, I don't know, 4 weeks already 20 times. You got the owner's capital, which is the same as like the old capital and includes the investments. You got the withdrawals. And of course the revenues and expenses. These are the major accounts, equity accounts. Okay. We have now an account, and I'll be explaining a little bit, but it's fairly simple. For each account, we already discussed previous time, is the plus and the minus sign, increasing and decreasing. The easiest one to remember is withdrawal. You take money out of the business, equity goes down, okay? You got the minus sign. Everything perfectly familiar. You put in more money in the business, you make an investment, equity goes up. Again, remember the key word, equity is same as capital. Exactly the same. Exactly the same as owner's capital. So, equity goes up, equity goes down. Similar, revenue goes up, expense, meaning the equity, goes down. Okay, so expenses decrease equity, revenues increase equity. Investments increase equity, withdrawals decrease. You all got that. That's will be coming on quiz number 1. Okay. Okay. Now we're getting to the ledger and the accounts. We should have here also the accounts. We're going to worry about it. Okay. So, what is a ledger? A ledger is simply a number of accounts. You guys want to take a break, right?
Yes.
Okay, take a break.